Hello, 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 everybody. I am Rosalind Brown of Your Wealth Guidance, where we help Black women create their financial independence map and identify the tools for success so you can live life on your own terms. Thank you so much for being with us today. Be sure to hit the subscribe button, like this video, and turn on notifications so you never miss one of our great speakers. And today we have a really good one, this issue that so many people are dealing with. So we hear 1,000 times over, go ahead and start your business, make your side hustle a business, leave your 9 to 5, and all those kind of things. Well, there's a way to do everything. And if you do it wrong, you might end up wasting money or spending more money instead of making money. So today we have Alex. She is a certified public accountant, certified financial planning professional, and licensed life, health, and annuity agent. She is the founder and CEO of AGA Tax and Consulting Services, LLC, a boutique tax and financial coaching firm dedicated to help entrepreneurs build wealth through strategic tax, financial planning, and changing their relationship with money. Child, everybody need to look and see what they're doing in terms of their relationship with money.
Absolutely.
That's definitely a big one. And so when we think about kind of those foundational things, so people are like, all right, I got a side hustle. I want to turn that into a business. What are some of the first things they should be thinking of? People typically initially go, let me get my LLC. Does that always make sense? Should they be sole proprietor? We know they should just be, on the Cash App collecting money.
Right. First is to make sure it's a business. Is it generating income? So that would be my first step, because a lot of times the whole LLC movement is very strong. But if you're not bringing in money to warrant really that separation, it may not be your time. Now, I will say, if you are in you have a business that there's a lot of personal liability that you could be taking on, like you're a construction worker and you're building homes, that's a lot of liabilities if a home falls down. You absolutely want the LLC because it separates it from your personal name. Sole proprietor, there's no separation. All the liability is on you as an individual. But setting up the LLC, the primary function of that is really establishing that liability protection for you. And then there can be some tax benefits with it if you make certain elections. But the first step I would say is make sure that the business is generating income. And there's not substantial personal liability. Otherwise, you may be better off just being a sole proprietor for now until you start building up your income stream.
And that's a good thing. Now, in terms of options, so we talked about sole proprietor, and that's basically, hey, just you doing your thing. Now, what are some of the other options that exist out there?
Yes, absolutely. So you have your sole proprietor, and then when you become an LLC, I want to make sure that you understand that an LLC is actually a state designation. That is not a type of entity necessarily from the IRS perspective. So you can't file an LLC tax return. And so you can be taxed if there's multiple members. You would be a partnership. So that may be an option for you. And there are various types of partnerships. And I may not get into all that today, but just keep in mind that if there's more than one business owner, you're looking at a partnership. You could also be a C corporation. And so that basically is completely separate from you. All the income is taxed in that individual entity as a standalone business. An S corporation, you can elect to be taxed as an S corporation. So that is an option. And then if you are an LLC, but there's only one member, you are technically treated just the same as you would be if you were a sole proprietor. The other instance where I see an LLC for a sole member being beneficial is if you are looking to build standalone business credit. Even if you don't have the income coming in, that may be a great option for you because banks and credit building want to see you with your individual EIN number for that business. So that may be another reason to have an LLC.
Now, how do you know when you should switch from one to the other? So you got your sole proprietor, you selling widgets or whatever you're selling, and you're like, okay, it's time to switch. How do I know when to switch?
It really, really depends. So I can give you some things to look for when you may consider switching, but it really depends on everything else that you have going on. So when you are working with someone, and I do encourage you to work with a professional in setting up your entity, even if you feel like you can handle everything else, at least work with someone to be able to review everything that you have going on and make sure you're getting set up in the proper entity. But some things to consider when the switch is, as I mentioned, liability purposes. So if when you started, you were a sole proprietor, you had no assets, and then now you've grown your business, the income is growing, but then you've also added some assets. Now you have homes, you have multiple cars in your household. So now it's not just you that's being responsible. There are other people in your household that are now driving cars where you could be liable. You will want to consider an LLC. So anytime like your liability or assets that you have, you want to make sure that you're protecting them, you want to consider an LLC. Once your income gets to a certain threshold, you would consider an LLC and perhaps making the election to become an S corporation. I've heard various numbers. Typically, my clients benefit when their net income, that is your revenue less your operating expenses, when that income becomes about $40,000 to $50,000, typically is when I see really great benefits from switching from the sole proprietor to an S corporation or becoming, it's mainly switching to the S corporation because an LLC, a single member LLC, is taxed as a sole proprietor. So unless you're making an S election, there's really no difference for tax purposes between the sole proprietor and single member LLC. So those are kind of the main reasons: is income based and liability, and then also when you're looking to start building business credit, because typically you need to and as a sole proprietor, you could do a DBA and get a separate EIN number, but most times it's just better to have a separate LLC so that when you're building your credit, and then also when lenders are looking to work with you, they can actually look and see that you're registered with the state and that you have your own separate EIN number as you start building your business credit.
I think that's a really good point. Now we're up against kind of the end or almost at the end of the tax year in terms of filing. What are some of the mistakes other than not filing your taxes on time that you're seeing from some of these business owners at this time of the year?
One I see is not really having bookkeeping systems in place. And so you're scrambling to basically prepare information from a year ago. I don't remember what I had for lunch sometimes. So then to try and go back, analyze what this expense was for, what this income item was reported, trying to summarize receipts. So I see just lack of proper bookkeeping. And a lot of times what it leads to is just missing out on deductions and not having actually solid financials to report. That's one mistake I see a lot. At the end of the year, like lack of financial planning. So what happens is when you don't actually plan throughout the year and you wait to, and at the end of the year, we're filing your tax return. If you haven't done proactive tax planning, a lot of times you end up overpaying in taxes because there's not much you can do once the year is closed. And so it's really important. So this time of year, we're in October of 2022. This is the time of year to be working with your accountant to really plan, instead of now you're filing your tax return and trying to plan for a year that has already closed. So those are some of the major mistakes that I see.
Now, what are some of the ways that people can save on taxes? We hear a lot of stuff online. Folks like, you can write off every meal. If you and your homegirl go out to eat, you can write off your car, all those kind of things. What are some of the write-offs that people can actually do or have? And what are some of the things that maybe people are hearing part of, but not everything that means that is legal?
Listen, we don't have enough time for that. But some of the ones that I see that doesn't always get captured, especially this year for 2022, you are eligible to write off 100% of your meals if you are actually going out to restaurant types and you are discussing business. So if you are actually just going out by yourself to lunch, that's actually not 100% write off. You're with yourself. You're not talking to anyone about business. And you talking to yourself, the IRS does not count that.
Right,
So
right.
that's one mistake that I do see, is that they will say you can write off 100% of your meals, but there are rules to that. And I recommend for individuals, if you are writing off meals, just make sure that either you save a receipt or you make a note in your bookkeeping software. I personally recommend like a QuickBooks Online or Wave are some of my favorites. Xero is also a popular platform that you can use. But just make a note in the memo section: dinner with such and such, business topic discussed such and such. So at least that way you have a note in there. So should you ever come under audit and you have to prove that, yes, these are actual expenses, make sure that you have the information there. Another mistake I see is people will write off entertainment, like going to a baseball or football game, and you may be there entertaining clients, but that could be deemed as entertainment. And entertainment is 100% non-deductible. So just making sure you look at that and figure out, is that entertainment, or are you saying that this is a form of advertising? Because if it's advertising, that's deductible. If it's entertainment, it is not. And so making sure that you're classifying your expenses correctly, because if they are not classified correctly, most likely your CPA that's preparing your tax return, if it's coded as entertainment, we're not going through your general ledger to really question whether or not it's entertainment or something else. Now, if you have a really good CPA, they are going to ask you, say, hey, I always confirm before I write off something that's 100% non-deductible, and say, hey, is this really 100% non-deductible? I'll confirm. But a lot of times that's not what's happening, especially if you're not paying your CPA to go that extra step to ask those extra questions. So coding your expenses, that's a big one that I see that's not always discussed in I would say social media land. YouTube University, they're not doing that. And then when we talk about the writing off of the car, make sure it makes sense first off, because they say, oh, you can buy your G-Wagon and write off 100% of $100,000. And do you have the cash flow for that? Does it make sense? And then are you really tracking it? Because that's the part I feel like I see left out a lot, is they don't really explain to you that you need to make sure you're tracking your business miles versus your personal miles. And if your business is not more than 50% of the mileage, that is really going to cause you actually to pay tax on that. So there are rules for it to be 100% deductible. And then the main thing is they don't discuss the type of documentation that you need. That may be a lot. So hopefully
they're audited. You like, yeah, I know they gonna ask for a whole bunch of stuff.
So that's my thing. I always tell people, most likely if it's business related, you can write it off. But what you do not want to do is not have it documented properly, because that's the big thing. Have your documentation in order, and a lot of times that's not done. And then to try and go back and get it documented after 2 years, because this is what you all need to know about the IRS. They may not catch you right away, but they have some time to go and look at all those expenses that you've recorded, and you're showing these huge losses, and then that's a red flag to the IRS. They'll show up right before the statute of limitation is about to expire and say, prove this. Now, if you haven't documented it in advance, now you have to go back and, okay, what did I do 3 years ago? You don't remember that.
Now, this is a good question. Simone asks, her tax advisor told her she needs a bookkeeper and not to do it herself. She's really adamant about that. She says her business will only gross about $4,000. It just started. So is it worth it now to have a bookkeeper?
I think it would be helpful to at least get them set it up for you. So if you feel like someone can get it set up for you and then you can take it and go, because what is it, like $4,000 a month is she's generating, or just $4,000 total?
I don't know. Simone, you got to give us some clarification there.
Okay. So I'll give two answers. If you're generating about $4,000 of income a year, it may be better off just to put it in Excel and just do super detailed where you're writing out all of your expenses. I always recommend that you reconcile your bank account, and if you are a business owner, you need a separate business bank account. Start there. You have to have a separate business bank account. And you may be able to use Excel. Maybe you're not ready for tax software. You don't need it. Now, if you're generating like $4,000 a month, or you know that the business is expected to grow, I would say start how you want to finish. So even if it's just a matter of getting with someone, and there are bookkeepers out there that help you set up your account, make sure that all your accounts are set up properly. They give you the proper reports that you want to look at so you can actually see how the business is doing, and connect all your bank accounts. That's the cool thing, especially about QuickBooks. You can connect your bank accounts, your business credit cards, and you can give it rules to say, hey, every time AT&T is withdrawn from my account, this is my business cell phone. And so it takes away some of the work. And so at least have them set it up. So then moving forward, and they can even tell you, hey, these are the things you do need to keep track of it. So that way, when it's time to do your tax return, you have clean financials. When you want to go, this is the other thing, entrepreneurs, I spend a lot of time helping entrepreneurs fix this, is now they want to go get their mortgage, or they want to get business credit, and they are asking for financials. But if you don't have a bookkeeping system in place, or if you haven't been tracking it and the books are a mess, you may not get approved for your loan. And you don't want to be reactive. You really want to be proactive. So that way, if you know that you have plans of buying a house soon or getting investment, things like that, get in front of it. And so my answer would be, if you have a business, at least have a bookkeeper started. And then if you're really looking to grow, you definitely want a bookkeeper that's at least reviewing it quarterly or annually to make sure that everything looks good.
Yeah, because somebody said that she uses Wave. I've used Xero. You mentioned QuickBooks. And Simone, it might be just, this is maybe not right now, but in a few weeks, you can reach out to someone and say, hey, can you help me set this up? And sometimes just if they set it up, it's easy enough to kind of go in, out, and back. Because I know for mine, it just says you have X amount of dollars that have not been reconciled. So then I go in there and I'm like, all right, what did I do? And hopefully you don't wait a whole year.
Yeah, I don't recommend that.
Like, I don't remember buying that. I don't remember what I needed that thing for. But that's one of the things that you can really start to pull those in. And especially if you can take some pictures, because a lot of them allow you to take a picture and put the picture into the system. You don't want to be like me, and some of these receipts are like blank.
So right.
I don't know what that is.
What? And, I don't know. And then you made a great point. Try not to wait a year. My rule of thumb is I try and have a date night just with my finances. Ideally it's once a week, but I won't lie. Sometimes it's every 2 weeks. Sometimes it's once a month. But try and do it pretty frequently, and just whatever your favorite dinner is. Whatever if you like wine, I'm a wine girl myself. Get you some
wine after though, because you might be messing stuff up if you have
just a little sip, or that's your reward, or that's your reward when you're done. But whatever you need to be like, all right, this is fun. Make it fun, so that way it forces you to sit down and do it. Put it on your calendar. That helps me when I put it on my calendar to say, okay, well, this is my finance date night. So that way you do it on a regular basis. And then it just becomes part of your life. So that way it won't be a year or 6 months. And like you say, trying to go back and read receipts and remember, that's too much.
Yeah. I mean, if you wait too long, it's definitely harder. Now, this is a great question. Not Before 10 says, can you use your business credit card statement instead of having individual receipts?
So you can use that for bookkeeping purposes. And if you put notes on it, that should work. Now, if you go under audit, most times the IRS is not going to nickel and dime you for small expenses. But once you start getting into, like, my rule of thumb is if it's over $1,000, I'm just keeping receipts or making really detailed notes about what it was. Because typically, even with credit cards, you can go back and pull receipts in the future, or you can scan them. I don't recommend keeping paper receipts whatsoever. But if you want to scan it, or like Rosalind mentioned, you can take a picture of it. But typically, the IRS is not going to have you have to send in receipts.
Especially things like, if you was over at the Costco spending $100 every month, they're going to be like, were you buying groceries every month for the house? And so those are some of the things you might need to, actually have a receipt for. more so than some other things.
Yeah, and then depending on what like in total they are, because the IRS is not typically they're not taking their time for those types of like kind of small expenses. But it's a good rule of thumb to not commingle funds, and then you don't even have to worry about it. So if you could confidently say, no, I only use my business card for business expenses, that's gonna bolster your claim that no, this is a business expense and I just don't happen to have the receipt, but it's clearly you can see it's from Office Depot. Most likely it's going to be an expense. Now, if you're going to the Ritz, the spa, you know that how is this business related?
Research.
You know, how is this business
customer
related?
Service.
And yeah, it's like no, that doesn't work. And I will share another expense that could catch people is gifts. We give gifts to clients. And then recently I saw on social media where someone had mentioned they were buying a business owner and they were looking for cars to buy their mom as a gift from their business. And they were going to be able to write off the car 100%. Well, there are a couple of things that are wrong with that. And I don't have all the backstory, but you can't gift a car. You can't buy a car in the business name and gift it to a family member and then write it off for two reasons. One, the gift threshold for the IRS is $25. So as a business owner, if you are giving gifts to clients, anything over $25 is technically not tax deductible. Now, again, if this is, you're putting your logo on it and you're using it as advertisement or promotion, that's different. But to outright give a client this gift for flowers, technically the threshold for that is only $25. Everything else is non-deductible. That's one thing. Second reason is if you're gifting a person a car out of the business and they're not using it for the business, it's fully 100% personal use, that's not a business deduction. The IRS won't allow that. That will not hold up in court. So just be careful with gifting, especially from the business, and understanding that there are special rules surrounding that. And then I'm going to take this just one step further. If you give more than, I believe the threshold this year is $16,000. It can be cash. It could be anything valued at $16,000 or more. You should be filing what's called a gift tax return. So just keep that in the back of your mind if that's something that you're doing, because that's something we forget. So like sometimes you'll transfer a house to someone, not realizing, well, that's a gift. If you didn't receive the value of that in property in exchange, you've just gifted someone something, and technically
it's not fair market value. So
you're right, it's not fair market value. You have now gifted.
And I'm going to charge $1.
Yeah, and so you just want to pay attention to that, because those gifts will get you caught up. But that was one that was really popular floating around. I was like, ooh, there's a lot of wrong in this. Now, obviously, there's only so much you can do in 90 seconds, but just making sure that you're digging a little bit deeper when I always say you shouldn't be taking your tax advice from the internet anyhow. Sit down with someone who understands your personal situation, because even the information I'm giving you, it may not work for your personal situation. So making sure you're actually working with someone that knows your situation.
I want to come back to that. Now, you made me think of this question that I saw on social media, and they were going back and forth in terms of, is this considered to be a business meal? So someone bought a custom cake. So I don't know, some cake like, I don't know, in the shape of a shoe or whatever, and it's a birthday cake. So they wanted to take it to their client. And so the debate was, is this deductible? Is it deductible if they sit and have a slice of cake? So now they're eating cake with the client, or if they just drop the cake off? What are your thoughts there?
That's a little dicey. Now, if they're saying, hey, we're having dessert together and we're talking business, that's a business deduction. Now, if she's just dropping the cake off, hey, happy birthday, it was great seeing you, and leaving, no, that's not going to drive. She could consider it a business gift, right, and take $25 deduction.
I was like,
right. You take her $25 deduction for it, and then not the rest. But if she's sitting there and then they're talking about the business and giving her some business advice, whatever her business is, yeah, I would argue that that's a business deduction.
Oh, see, I love it. If anybody want to buy me a cake, my birthday in May.
Yes,
I like
yes.
all the like all the fancy cakes, and I will eat all the cakes with you and chat about anything.
Right.
Anything you want to talk about. Now, going back to what you said before, in terms of your tax professional and where are you getting advice? Now, as we're trying to figure out who are we going to work with. So, I don't know about y'all, but years ago, I was, whatever app, whatever was free. So I was turbo taxing it and all that kind of stuff. So you move on from that and you say, okay, I need a person. What are some of the things to ask this person? What are some of the ways that I'm working with somebody who knows what they're talking about?
Oh yeah. So I like to start with just ask them what is their experience. Find out how long they've been doing taxes, exactly what they do, because tax preparation and tax planning, totally different areas. So if you are just looking for someone to take your information and do the tax return, they may or may not give you recommendations about your deductions and things that you are missing, compared to someone who you want to actually analyze your reports, really give you additional feedback, create strategies that are going to save you tax. So find out exactly what are their roles. Ask them what are their industry. Find out if you are a beautician, have they worked with other beauticians? Because they being working with someone that has specifically in your industry is just helpful, because they've identified deductions that gets missed a lot. And then they're able to offer other information, like what licenses should you be considering, making sure that you're filing, what other types of returns, because it's not just tax returns. Sometimes you need sales tax returns filed, and if you're working with someone who doesn't have experience there, you could be missing out on tax filings with your state. And let me tell you something, if you think the IRS is nasty, get involved with the state taxing authority. They have employees and time. They are not as overworked as the IRS.
I need to talk to you and see about that.
Okay, they will come after you for $100. I've seen it, and I'm like, why are you bothering us about this? But so just they have a better understanding of, most times, a better understanding of all the possible returns you may file and just what specifically someone in your industry would need. Find out about their professional designations. I'm not saying that you have to be designated to be a great tax professional or tax strategist. I'm not saying that at all. But I will say, when you're working with someone who's a CPA or an enrolled agent, someone who's gone to school, taken exams, someone who has their name on the line, like for real, they're not going to make mistakes and just like, oh, sorry about that. Whereas when you're working with some people who, I call them, it's the tax preparers that work from January through April. I'm not knocking that, but that's not what they eat and breathe. It's a lot of times it could be a money grab or another source of income, and they may not have gone and taken the extra time to study up on new tax law. They may not have the more experience with more complex topics that may come across their desk because they just aren't aware. So find out about their designation and, as I mentioned, their experience. Ask them about what their timeline is on communication, because that's the other thing. Find out if you're someone who you want someone who's accessible to you, or if you're okay waiting 2 weeks to be called back. I'm not okay waiting 2 weeks to be called back. I need a little bit.
$20 and want somebody to talk to you.
Right. You're right. Now, sometimes you get what you pay for. So if you pay $200 for your very large tax return, but then that's you deciding whether or not that's worth it. Ask them what their fees are and have them be transparent, and find out, okay, if something changes, will you be notified? But communication is huge, because what you don't want is you turning in your information, and because they're busy, they don't communicate with you. You're calling, no one's calling you back. That can be very, very frustrating. So those are some of the things to pay attention to.
I think that's a good one. Now, what are reasonable fees? So, you out there and you like, somebody said I can do it for free on whatever app. And then you're like, I don't know about y'all, but I was shocked. I was like, wait, hold up. It's a lot of money you talk about. So what is
Yes.
How do you know what is reasonable, especially if you're just starting out?
that super varies, because that depends on how much hand holding you want, how much personal advice you want, how much access you need. So it truly can vary. I would say I don't personally know any accountant who's offering tax planning along with tax preparation services that's going to charge you less than $500 a month. And that doesn't necessarily include bookkeeping. So bookkeeping will be typically at least a minimum, probably another $250, maybe another $500 a month for bookkeeping. And that's separate from tax prep and tax planning. So I don't think it would be unreasonable to pay $1,000 a month for solid bookkeeping and the tax prep and tax planning. With that being said, if you are willing to do your bookkeeping yourself, or you don't have a ton of activity, that may vary. So if you literally have 3 transactions, 3 expenses, and one source of income, no, you $250 a month for bookkeeping. At this point, do your bookkeeping yourself and get someone to do your tax planning for you to make sure. And even then, maybe you still do need tax planning, but just it'll also depend on the amount of activity you have within the businesses, the amount of businesses you have. But hopefully that was helpful.
Now, that's a really good point in terms of, okay, you just have a little bit, you're just starting. So maybe you can get by on Excel. Maybe then you graduate up to one of these apps that people are using, but you still need the tax planning. Now, what are some things to be aware of or that you should be having that discussion with in that tax planning? So we're in October, we got 2.5 months to make some moves.
Yeah.
And hopefully not have the same tax liability that we had in 2022. So what are some of those things we should be thinking of to say, what can I change? What can I do? How can I impact my tax liability before the end of the year?
Yes. So you would want to look at your revenue sources. So get an idea of what your net income is. So paying attention to that, because depending on where your net income is, that opens up so many planning opportunities as far as, do we need to focus on reducing your income? Do we need to look at retirement plans to help you reduce your income? Are there some credits that you can take advantage of? So really starting at what is your income? What are your other sources of income as well? When it, because we're talking about your business, but if you have investment income, what in your total financial picture can we do as we get to year end? Bonusing, figuring out if you are taking a salary with your business, making sure you're paying yourself a reasonable wage if that's the type of entity you're in that's requiring that. Some entities we're looking at, okay, can bonuses be paid out to reduce some of that income? Are there some purchases that you can make that can make you eligible for some of these credits? So really getting a solid handle on your financials, making sure that your financials are in order. So right now we are October 11th. So if you haven't reconciled through September, let's make that priority numero uno. Getting your financials reconciled through September. So that way we're looking at really solid numbers as we're making recommendations, because that's what tax planning, you cannot plan with bad financials. It's just impossible. You can plan it, but it's not going to be accurate if we're not looking at the most up-to-date income and expenses that you have. So those are kind of be my top things.
Now, you mentioned business credit, and the business credit is always coming up because people are like, oh, you can buy this in your business name. It won't hit your personal credit report. You could walk away if you want to, all those kind of things in terms of the business credit. So as you're building business credit, one, what things can you not buy under your business name? Just, can you get a phone for everybody in the family? Because some phone carrier said, oh, yes, you can have business lines. Or, we already talked about the car thing, but could it be, I'm going to buy my kids some computers, put that in my business name? What are some of those things that people are like, oh, I'm using my business credit, and they probably shouldn't use their business credit?
Yeah, if it's not business related, I would say don't use your business credit or use your business account. You really want to make sure you're not commingling funds. A couple reasons. it messes up your finances, your financials. And if you're paying a bookkeeper and they're having to do a lot of reclassification and do a lot of cleanup, that's going to increase your fees for that. Next, liability. When you are commingling your personal account with your business and you have an LLC, that's called basically, or a C corp, piercing the corporate veil. So now they're looking at this and saying, well, wait a minute, you're using this as your personal piggy bank. These aren't really two separate entities. You don't get liability protection. So if it's not business related, I don't encourage you to do that. And then the other thing that I think, some of these social media gurus is that they don't really say is when you, and a lot of times they are using this no personal guarantee where they want you to just use business credit and not guarantee it with your personal name, your interest rates are much higher. So unless you are actually generating income that warrants the higher interest rates where it doesn't matter, and you really want the liability protection, there's really sometimes not a reason to put a car in your business name and be paying 12% versus if you had guaranteed it with your personal name, and then you could pay 6%. So making sure that you are looking at the agreements and finding out, okay, does this make sense?
I like that. That's a really good point in terms of, so what are some of the benefits of having business credit and some of the ways in order to actually build up some business credit?
Well, it's great to have it because, like they mentioned, it doesn't always show on your personal credit. So, credit cards are helpful, especially in the business name when you're using it to buy business assets. Because I'm a component for OPM, other people's money. If you can leverage other people's money to build your nest egg quicker, I love that. But make sure you're being strategic about it and you have a plan. It's not just, oh, business credit, I can get larger balances and run it up, with not a plan. That's not what it's about. But I love business credit because it gives you a better opportunity to leverage other people's money. And it's just good debt is helpful in building your wealth when used properly. And so I will tell you, I am not a business credit guru. I can only kind of tell you what I did for my personal self. And I'm sure the business credit gurus, it may not be the right way to do it. I just started with my own personal credit. I made sure that my credit was right. And you know the rules about credit, pay your bills on time. Keep your utilization rate, which is basically what's available, what's your total availability credit limit on your credit card, and making sure that you don't have a balance that exceeds 30% of that. So I made sure of that. I have a pretty healthy mix of credit in my personal name. And so for myself, my credit is usually high 700s to 800. It ranges between there. So I started with myself. And then after that, with my business credit, then I apply for something in my business name, and you piggybacked off my personal credit, got approved, and now the business starts building its own credit. And then just in the business, I have about 100,000 in credit lines just from starting on my own. I don't know. I'm sure I can look up like all the tips and tricks, but I just tell people I'm all about a solid foundation. Get yourself solid and then build your business. It will all work out. I'm not gonna lie. I don't get into the whole no personal guarantee, have great, amazing business credit, but your personal credit is all jacked up. No, I'm starting with home, which is you.
And I would say things like SBA, a lot of times they're going to be like, hey, we pulling your credit too. We want you. And so you may limit yourself in how big or how much you can get and how much you can grow.
Right.
We talking about other people's money, they like, hey, this is my money.
Right. And that's the thing with not having a personal guarantee. It's riskier, right? Like they don't have anybody to go after. If you say, all right, see, I'm out of here. They don't have anybody to go after. So now they want it just, yeah, you're right. They will look back to the owner and say, okay, show me how trustworthy you are. And unfortunately, they deem how trustworthy you are based on your credit to see if you have been responsible with it.
And this is a good question. I know a lot of people are in this similar situation. So she incurred business expenses months prior to actually officially registering the business. Are those things that she could then write off? So those kind of expenses to get the business in place and moving.
Yes, absolutely. So those are called like startup costs, and automatically you can do 5,000, and depending on the type of expenses, you may be able to do more. But typically, you can write off 5,000 of the startup costs right away, and then you want to make sure that you are capturing that. So if you do have financials, if you're in QuickBooks or Wave, you want to make sure that you actually do report that, so you can add that to your financials, and then that would just look like it's been a personal contribution from you as the owner.
I think that's a good. Somebody says preach good credit practices to family members. Yes. And you can't simply just get away from your bad credit and say, I'm just going to do everything in my business name, because once again, it might not be your business. You might be commingling. So yeah,
Right.
I'll just think I'm put everything over here on this
Yeah.
side.
Yeah. Just do. I'm really a just component of doing things the right way. I think a lot of times shortcuts work in the short term, but I'm about building long-term wealth and legacy, and so we're gonna get things set up the right way. So because I see this all the time with a lot of business owners, is they were starting and they were going. Now their business has grown and they're looking to level up, but they have so much to clean up. When if we start the right way, we start the right foundational work, you're not playing so much catch up. And it may feel like in the moment, oh, this is so much work, or oh, this is so much extra money. But I promise you, in the long run, typically you're going to just make that money you spend back, that you spent to get it right, you're going to make it back exponentially.
I have a question. And so many people are like, you need a business so you can write all these things off. So great. You've reduced your income, you've reduced your tax liability. How many years can you be an unprofitable business?
So the IRS gives you 3 years. 3 years to be unprofitable, and then they could come in and say, okay, is this a business or is it a hobby? And you don't want that. Now, could you be a business who you are in business to make a profit and you just have some bad years? Absolutely. But I would say if that is indeed the case, you may want to consider looking elsewhere and seeing if maybe you're not in the right business. If there's not even an inkling that you're going to become profitable, but the IRS starts to look at you to say, okay, is this a hobby or a business when you're having like 3 years of consecutive losses? Because you're in business to make profit, right? And so if that's not happening, that could be questionable. And then the other thing, and I love that you mentioned that, is that they also get a business, write everything off. That's fine and dandy until you want to go get a loan. I spent countless hours working with taxpayers who are now ready to buy a home, but they didn't want to pay taxes. And so they worked with their previous accountant and they were like, yeah, write everything in the kitchen sink out, whatever. And now they take these tax returns to the bank and they're like, we're not loaning you money. You keep saying you're losing money. Why would I trust you how are you going to pay this loan? And so then they have to go and actually amend their tax returns, which now they're paying penalties, because most times they now owe tax. They're paying penalties, they're paying interest, and that can be a lot of money to come up with at the drop of a dime, as opposed to
when you're trying to buy a house.
Right. That's stressful, right? And then you have to make sure you find someone who knows what they're doing and that's comfortable now going back and saying, well, how did you miss all this income before? I'm not sure if I'm comfortable amending these, because did you lie before or are you lying now? Or was it just a mistake? I don't know. I don't want to just call people flat out liars, but you make sure, then like I said, you have to find someone who's willing to even amend them for you.
And so someone said they just learned this last year. But it's a big thing, and it's part of having a team. So not just having someone who does a transaction for you. So when you're in this moment, so taxes are due in a week or so. So you probably don't want to call them today, but in a week or so, you can call them and say, I want to talk about 2022. I want to talk about 2023. I want to talk about 2024. I am thinking of buying a home. Because they need to look through that lens. but it's all of your team. And I know I've talked about kind of putting together your team, and it's your team of everybody. So it's having a banker, having someone who can advocate for you and say, oh, no, this is a good business. Like, oh, no, this is definitely somebody we should make an exception for. But making sure your team all knows where you're going. So you're not just going in and saying, all right, Alex, here go all my stuff, get my taxes done, here go your money, and I'm never going to talk to you again until next year, same time, same place. But if you're strategizing together and you're saying, okay, next year, I plan to, whether it's maybe buy a building for my business or buy a house or what have you, it's through that lens that the taxes should be done. It's through that lens that whoever it is, if it's your CPA, but if it's your banker, to say, all right, these are some of the things you're going to need. Or they might even say credit quality is down. So we're being a lot more conservative. So you might need something smaller. You might need a higher income. You might, and they can tell you together where you need to be. Your bank can say, all right, this is how much money you're going to need to show. And then you talk to your CPA and say, does this make sense? Can we get that sort of thing?
Exactly. But you hit the nail on the head with that one, is having a team and having people who are asking these questions, right? Because I make that part of my client intake form. I'm working with clients. What are your plans over the next 1 to 3 years? Just to have an idea to find out, okay, where they're at. So if their income is substantial loan, they tell me that they want to buy a home, I'm going to ask them questions about, okay, are we capturing all of your income? Are you over reporting any of these expenses here? And then I also, I get to know my client, so I can give them income generating ideas. Hey, have you thought about X, Y, and Z? So I've been able to help clients actually increase their income by just simply making recommendations, because those are things that I do. But that's not every CPA. So finding out what your person does for you and is capable of doing for you, and then having the right team around you. But really looking at what are your goals. That goes really on. I don't think that enough attention is paid to that. What are your goals, and just talking about it. And so sometimes if your tax return is super simple, you may not actually need necessarily a CPA. But I always recommend either a CPA with some financial planning type of background, or a financial planner who is looking at your short and long-term goals and giving you recommendations, so that way you can just more easily start to achieve them. It's hard out here trying to do everything by yourself, because we only know so much. So it's you have to sometimes lean onto experts, unless you really want to just dive in and learn all this stuff yourself. And
even then it's going to change. So even if you dive in and learn all the tax stuff today,
that's true.
They out there making some changes. They listen, taxes ain't gonna be the same next year. So either you're gonna again, or laws are gonna change, or whatever your local jurisdiction saying you got to do. All those things are gonna change. I say don't try and learn it. Be great in your business and find great people to help you. Do not try and learn it. You're gonna waste time. You could have been making money in your business, and you trying to learn something that ain't making you no money. Don't.
Yeah. That's my philosophy as well. Operate in your zone of genius.
Now, this is a really good question, and I'm going to add a part to this question. So she has a side hustle. She's pretty sure she should be W-2 instead of W-9. Based on the background, she recognizes some FLSA violations, but she's not litigious. She said she ain't trying to go to court for nobody. Should she be writing off her W-9 expenses, or should she have a conversation about being a W-2? And I'm going to flip that too for business owners.
Ooh.
A lot of folks listen, I ain't trying to handle W-2 because I got to pay all this stuff for these people. When do you have to W-2 versus W-9?
Listen, that is a really dicey area, and you do not want to get caught up with the DOL, Department of Labor. Their penalties are pretty steep. So I'll answer her question. If she is a W-9, yes, she absolutely can write off her expenses. Make sure you're tracking mileage. That's a huge expense that a lot of clients don't actually always get because they don't take it. But if you do actually believe you are and should be a W-2 employee, and a lot of times different states have special rules, it may be worth having that conversation if you have information and say, hey, this is why I believe that I am a W-2 employee. And they really need to fix that, because they're at this self-employment tax is huge. And if they're supposed to be paying half of that for you, that's what they should be doing. You know, the rules are in place to protect the employee, because and then, so I can give you some examples. It really goes to the control that the employer has on your day-to-day work and performance. So if they're telling you when, typically, now every state is different. And California, I think, is really, California.
Everybody a W-2.
Basically, right. Florida is a little bit looser. You know, it's wild, wild west down here. And so, but look into, does the employer control the hours that you work? Are you using the employer's tools? Like, are you required to use their computers, their software, these things? Are you required to wear and dress a certain way based on them? Are a lot of the rules based on the employer's rules, or do you have autonomy? And if you start checking, no, I have to follow the rules for that. Oh, no, I have to follow all the employee. If you have to follow an employee manual for employees, right there, it's not looking good for your employer. Like, that's not a 1099 function. And just because they say, oh, you're a 1099 employee, but then they have all these rules for you, no, that's not how that works. So, I mean, it's up to you, but they are in gross violation. So if you were to report them, they would have some significant fines. You know, you perhaps, well, no, I'm not gonna say that on a live recording. But, you know, you just go in there and talk to them and say, hey, you know, I just want to help you out. So that way you don't have to pay all these fees. And my rate is going up.
Now, so what if you about a girl? So you at the club, you got to be there at 9, 10, whatever that is. You got to wear, you know, they little top, they little shorts, and, you know, they're supplying you the little sparklers.
Oh, you're an employee. That sounds very much an employee. Like, you have to do their hours. You're wearing their, you can't come in there and say, oh, I'm just going to wear this tonight. You can't show up when you want to. You have to use all their equipment. That's an employee. Oh, and I didn't answer your last part of your question. Was us as business owners, we really need to have an understanding of whether or not we have contractors or if we do have employees. Just because we give someone a W-9 does not mean that makes them a contractor. That's no. You need to look at what are you having this person do, and how much control do you have on their day-to-day work environment and duties. And so just pay attention to that, because just like she can report to her employee and say, hey, you need to change this, someone can do the same thing to you if they've looked it up and they're like, wait a minute, I'm an employee and they haven't been paying my payroll taxes. So in addition to paying their payroll taxes, like I said, Department of Labor, those penalties can be pretty steep. So you want to just make sure that you are, a lot of times you can either, if you have a question about it, you can get with an employee attorney there. You know, they can maybe do a consultation with you, and you can say, hey, this is what it is. You can have them look at your employee contracts, your general contractors type of contracts, and see, like, okay, is the language in here 100%? So that way there's no question that this person is actually a contractor and not an employee. So again, it goes back to having a team in place. Because what I would say is the IRS and these state taxing agencies, typically, I didn't know does not work. They don't care. And they will still penalize you. And so just, again, if there's a question about it, go ahead and get with a professional and ask some specifics.
And Simone, you asked about the dream team. We've talked about this a number of times, and the team grows as you grow and your needs are more sophisticated. But at a very minimum, you need a banker and a bank relationship. So that is, if you are like me and you're like, listen, I'll never go into a bank. I'm doing everything on the phone. No, you need to go in there and open your account, and you need to have a conversation, drop in and say, this is where my business is going. Tell me about your current products. Tell me about your current solutions. One, because they can be that person that sits in the branch that is right there kind of helping you open the account. They can be the gateway throughout the rest of the organization. So as you're talking about what you have, they might say, oh, wait, you qualify for our wealth management team. get you over there. And now you have access to new solutions and services. They might say, you know what, based on what you're saying, you should be talking to my small business banker. And so that person is going to have some specialized things to talk about from a credit perspective. And that gets you kind of deeper into that relationship. But they'll also talk about, did you know this? Did you know that? One thing with PPP loans, most people weren't aware that if you didn't have a bank relationship, those banks weren't helping you first. So they were helping their clients first. So somebody was able to get the money and keep their business afloat and get going quicker than other people because they didn't have that relationship. So that's one. Having somebody on the tax side, because child, no matter what, it don't matter if you making $100 or $100,000. IRS like, let me get some of that. So you want to know how much you got to give them, and you want to be able to anticipate. I like a tax professional that is going to tell me about what we are going to see next year. So they'll say, if things are like they were last year, this is what we're anticipating. So they're going to tell you, these are some tax changes that impact you. So that is important. And that's something, that's a relationship once again, because if somebody just doing your little, TurboTax or your H&R Blocks or whatever, and they're not working with you through where you're going next, and all they're trying to do is reduce your tax liability, you might be stuck when it's time to actually buy some things or invest in your business, those kind of things. An attorney, and there should be a general business attorney, but everyone also needs to have an estate attorney. If y'all have been here for more than a minute, you know how adamant I am about your overall estate planning. I'll go into this story another day. But those are things that are kind of primary. As we get a little bit further and more specialized, you definitely want to have more, you want to build up on these relationships. So there's some more people that we would want to add. But like I said, never work with anybody who like, I do everything. Child, it's too much information for them to know everything. Build a team with people who know. You want somebody who is deep, and you want somebody else who is deep, and somebody else who is deep. Not the jack of all trades. They miss something. Like, I've been in so many conferences about the same doggone thing because I am deep in areas, and I know how to find and connect with people who are deep in others. Don't be out there talking to people who like, oh, I do it all. Somebody said, would you recommend the same bank where your personal accounts are held? It could be. There's no reason that it doesn't have to be. So a lot of people have a banking relationship for their personal. You may or may not want that for your business. I will say from a business perspective, sometimes you can look at financial institutions who like your business. And what I mean by that, not everybody knows this, but there are banks that are like, listen, we don't do real estate. So if you're a real estate investor, we ain't making no loans over here. Well, you can put your money over here, but we ain't doing that. There are businesses there are banks who really like certain types of business. They like a restaurant. They like a CPA. They like an attorney. And then there are some that like others. There are some banks that take more risk than others. So if you like trying to barely make it, we talked about being in the cannabis industry. There are banks for that. Not any federal charter banks, but there are banks for that. But you want to know your business and know what they do. One thing I would say also from a banking side is once you get a relationship, get on their list because they have like 1,000 webinars and events and all this kind of stuff. And they'll bring people in and bring businesses together that are like either in size, in their current state, or the type of business. And then you can kind of get some of those resources as well. It doesn't have to be the same. If you like who you bank with personally, but ABC Bank, really, really likes your business, you can split them. But it can definitely come together as well. Sometimes they'll give you a little bit of benefit on one side versus the other. There are some things that can't be co-mingled in terms of from a benefit perspective, but I mean, there's no reason that it can't be both. And sometimes that's just easy from an overall banking perspective if you're looking at where all your money is in one place. Good questions. And I know we're kind of right up against the hour. A couple of questions. So tell us some of the worst mistakes that you've seen so far.
God. Well, because I've been doing this for 10 years, and so you can see a lot of mistakes over these 10 years. So filing late is a big one that I see. And so I think sometimes people if they can't file on time, they just say, I won't file an extension. And so you want to always file an extension. Even if you can't pay, go ahead and at least file an extension, because that will cut down on your failure to file penalty, which is much higher than failure to pay. Now, you do need to file by your extended due date. But I've seen clients that, had they filed an extension, could have saved them like $10,000 is what. So huge amount of money just for not filing an extension. So that's one mistake. And so keep that in mind. You want to always file on time, or at least file an extension. And you can go back and amend. So even if you do a best case scenario, look, this is a rough estimate, I can go back and amend to file the right way. I encourage you to do that, because those penalties add up really, really quick. Not having the right entity. Now that will cost you a lot of money. So I mentioned earlier about making an election to be considered an S corporation. That's probably one of the biggest mistakes I see, is people start making the money and they just weren't aware to make an S election. And so I've saved minimum sometimes like $20,000 for clients that, had we just made that election, they would have paid $20,000 less in tax. So not being in the right entity structure can cost you big time. Not keeping records. I mentioned about the mileage earlier. Right now it's 62 cents a mile that you can get a deduction. But if you aren't tracking your mileage, or I have this all the time where I'll get a tax return and I'll go back and review, and I'm like, do you have this expense? You have that expense? They're like, oh no one asked me about it. And some CPAs, they literally, and not just CPAs, some tax preparers, some enrolled agents, they file what you give them. If you don't give them information, they don't ask any extra questions. And so missing out on expenses that literally could save you thousands of dollars. That's one area that I see that I've had to clean up a bit. And I've done international tax. So if there's anyone on here who has accounts or retirement plans that are in foreign countries, that's another area that I see that, because I was in international tax, I saw it a lot. People not realizing that there's no tax to pay on that, but you have to disclose it. And when you don't disclose it, that can rack up huge penalties. And the IRS is now less forgiving on that, because you've had a decade. It's been about a decade since it came out with that ruling to disclose it. They're like, no, we've given you 10 years to disclose this information.
Like, I know.
They're over it. And so some people don't think about is their retirement accounts. You were working overseas and now you're here, that account's there, or that savings account is there, and you don't think about it. And you're like, oh, this is here. And then my last one, and because you touched on estate planning, is not having proper operating agreements in place, not having contingencies for what's going to happen in case something happens to you. And so I've seen a lot of times where just improper estate planning has caused extra tax to be due, or just how they wanted their business to continue wasn't what happened. And so they may not have lost a ton of money in some of these cases, but they lost the business that they would have wanted to keep in the family. And
that's a ton of money. That's generational wealth.
Yeah, it is. And so just making sure that you do have solid operating agreements, you have insurance in place, you have those types of things, will, trust in place, so that way, heavens forbid, something happens to your business, it's proper. It's going to pass on as you want it to.
Yeah, one thing about it is insurance is for if something happens. Estate planning is because something is going to happen. So
100%.
You going to die, or something going to happen before you die. Like, estate plan is because something will happen.
Yes.
Straight up die, which is, I hate to say this, the clean and easy way, or some stuff is going to happen before that. So insurance is for the if, but estate is for the guarantee. It's going to happen.
Right. It's going to happen. So get in front of it. And I always say, because I'm a control freak. I want to control my stuff now. I have breath in my body, so I can dictate, this is what I want, this is what I want, this is what I don't want. And then you do that while you're alive. You look at it like in that manner, like, oh yeah, I'm talking beyond the grave. There you go.
And I'll add this, not before Tim says, how do you forget you got money? I think sometimes it's not quote unquote they forgot. It's just they don't think they had to tell nobody. They like this ain't y'all money. This ain't the Uncle
Yeah.
Sam money.
Oh, and you know what else catches people up is you're a U.S. citizen, but a lot of people, they go when they're young. Like they may go off, their parents move them away when they're 15 years old. They've had a whole life in another country. They've built a life, and they come back to the U.S. and they think, oh, well, I wasn't living here. If you are a U.S. citizen, you are taxed on your worldwide income for life. The U.S. has you for life unless you expatriate. So that is another reason why people kind of forget. They were like you said, like, oh no, I didn't think I had to. Oh no, you do. You really, really do.
See, that sucks. That's definitely one of those shockers. I know we were talking about moving abroad, and if you want some more information on estate planning, it is, I believe, next week. I think it's next week. I have someone, we have talked to her before, and she specializes in trust. She is one of the only Black estate planners in the state of Georgia. And so that is a really big thing, but it also takes into account our cultural differences when we start planning for overall estate planning. See, Simone, this was a great thing. She said, cremate me, please. But you know what? And I meant to bring this up earlier. Sometimes people are like, oh, what's going to happen to me when I die? But what happens if you're incapacitated for 6 months and you get well? Somebody could have been sold a business by then. They did a contract. They done put some more debt in the business name. By the time you wake up, come through, you come back and you like, this ain't the business I built. They could have ran you to the ground. And so I always hate to say, death is the best case scenario. But if you don't die, there are a lot of things that can happen in the meantime. So definitely, join us next week. I want to say we're going to do it on an off day, so we're not going to do it on a Monday, but make sure you just turn on notifications because there's a few different things in this arena. One thing is how you title your estate is going to depend on what you qualify for as well. And when we start talking about estate taxes and all that kind of stuff. So definitely join us. I'm excited. And she talks about air property. If you look a few generations back, more than likely you got some air property because somebody died without a will. So you might have some of that as well. So definitely join us there. So we went through a few closing remarks. Alex, I always like to ask this question. What does financial independence look like for you?
Oh, yes, that's a good one. Just really being able to have time, financial, and mental freedom for me. That's the financial independence. Like when I have the independence, my financials have been able to get me to have that. Like I call it the trifecta. That's independence to me. Like I'm not stressing the mental of the money and earning the money. And then just having my time, being able to do with it what I please.
I love it. That having money gives a lot of freedom. So it ain't freedom from Uncle Sam, but it's still a lot of freedom. So we appreciate you for being with us today. And Alex, if somebody wants to talk to you, work with you, ask you a million questions, how do they reach you?
Yeah, so I have my YouTube page-ish. So that's coming up. You are motivating me to just keep going. And then I have my website, which is agataxservices.com, which that may be in here somewhere, but it's agataxservices.com. And then I'm on Instagram at Alexandria Chanel _CPA and LinkedIn with just Alexandria Davis. I'm keeping everyone on their toes with all these different names.
Right. We gotta get these
right. Get some of them simplified. But my name is Alexandria, and I'm just now really just saying, just call me Alex. That's too many syllables. It's too many syllables, but I haven't changed it everywhere just yet.
It's coming. So we looking for you. And if y'all need to contact her, I'll throw that in the description as well. So you'll be able to find her on all the different platforms. And until next time, I want to thank you all for joining us tonight and have a wonderful Tuesday evening.
Yes, thank you so much. Thank you for having me.